Welcome to Chapter 10. This is all about, well, the biggest part is with property, plant, and equipment. But we're going to spend a lot of time talking about sales and exchanges and monetary, non-monetary exchanges, ones with commercial substance, and so on. So that is actually the bulk of this chapter. Then we'll look at some revaluation and things like that. So it looks at property, plant, and equipment, several topics, some of which you're responsible for reading and learning on your own, because otherwise I'm just kind of reading the textbook to you. It's not an exam, but more you've got to learn it and memorize it or somehow internalize it, so it's just better you do it. Anyway. So I suggest you go through the textbook for Chapter 10 to supplement your reading. We're going to cover cost elements of PPE, and I'm going to do a little bit of it down here, but mostly you're going to have to read in the text as well. Non-monetary exchanges of PPE, critical. Details of costs of specific assets, so what goes into it. You can read that. We're going to do measurement after acquisition methods. And there's 3 of them. And costs incurred after acquisition, that's another part you're going to read. And I've added some extra questions and put the solutions online. Exercise 1029. Exercise 10.2, and that covers these ones that you're reading on your own. And then exercise 10.17, which covers part B. So those would be the first ones I do. These 2 because you've got to learn this stuff. And then this one to make sure you know your notes, then go on. Okay, so 10A is not required, 10B is required. That's going to be the revaluation approach. And in particular, the proponent method. Okay, before we get into here, I want us to go to page 10 and bring that up. Because I want to do the entries of purchase and sales of assets in case you don't remember them from introductory. Okay? So it's one little example with 2 parts. So January 5th, year 2, we purchase equipment, list price of $22,000. Remember, list price is just what they want for it. Like if you go and buy a car, there's a list price on it. Do you always pay that amount? No. So note that this is not fair or market value. And we paid $2,000 cash and signed a loan for $18,000. Equipment has a life of 10 years, and we use straight line depreciation on this class of asset. And then, on January 8th, year 4, we sell the equipment for $18,000. Now, with these questions, you guys, sometimes they aren't clear. If no year end is given, assume December 31st is the year end. So unless it tells you otherwise, it's going to be December 31st. So we want the purchase and the subsequent sale. So let's start with the January 5th, year 2, and that's the purchase. So the questions you want to ask yourself are, what do we record equipment at? If we have the fair value of the equipment, we can use that. But if we don't, you record the equipment, which is the new asset, at the fair value of the assets given up. Okay? So let's calculate. Okay, first let's see, do we have the fair value of the equipment? No, we've got a list price of $22,000. That's it. So we don't have the fair value, so we're going to calculate the fair value of assets given up. So what did we give up to get this equipment? Well, we paid $2,000 in cash, and we signed a loan. So we've got a notes payable for $18,000, or a loan payable, whatever. So that comes to $20,000 fair value, and this is going to be the new cost price value. Okay, however you want to think of it. So what are we getting? We're getting equipment. So we're going to debit equipment for $2,000. And we're going to credit cash for $2,000 and credit notes payable for $18,000. And that is the purchase. So does that make sense? Okay, now let's look at the sale. So January 8th, year 4. So 2 years have gone by, and we've got the sale. So what you need to do is record depreciation up to the date of the sale. The sale in the T accounts, or you don't actually have to do the entry. And since we do it at year end, we assume it's been done December 31st, year 3. So that was a few days ago. Are we going to record the depreciation? No, because we're not going to be that exact. What are our depreciation time periods? Not meths. Well, let's just write it down. Depreciation is recorded to the nearest month or half year. Assume nearest month unless stated otherwise. Okay, so that's 2 depreciation. So 2 years depreciation equals, do you remember the straight line formula? We'll just write it up here. Cost minus residual divided by life in years, or could be in units if it's units of production. Okay, oh, sorry, I'll just let you write that down. Okay, so cost was 20,000, calculated here. Did they give us any residual value? Nope. And it's over 10 years. 2,000 per year times 2 is 4,000. And just make a little note that it's already up to date. Now, if it was, let's say, April, beginning of April, then you'd do this times 2, plus you'd add 3 months worth of depreciation in. You would do the entry for the 3 months of depreciation, right, because it's not up to date, and you'd then do the entry to sell. Okay, so let's try piece this together. Leave some room for some debits, for some credits. So what's physically happening? We're selling equipment. Well, when we sold it, what did we get? Cash. So we're going to debit cash for 18,000. Now we have to take the equipment off our books. Well, that's easy. We credit equipment because it's leaving. And how much equipment sitting at? 20,000, right? You don't touch it again until we get to the end of this chapter. Okay, but what am I forgetting to close that's directly related to equipment? Accumulated depreciation. So we've got to close accumulated depreciation. And we already calculated it as 4,000. Okay, so does that balance? Nope. Are you short debits or credits? You're short credits of 2,000. So since it's a credit, it will be gain. Now, if you want to think of it in a more, so just let me write this in, fill in the blank. If debit, it would be a loss. Okay, a more formal way of thinking of the gain or the loss calculation, although this works all the time. Fair value of assets received minus the carrying value of the old asset, which is exactly what we're doing by filling in the blank. So we've got cash of 18,000 less the carrying or book value of the old asset is 20 minus so it's 18,000 minus 16,000. We've got $2,000. We got more assets on our books, so it's a gain. Okay, or fill in the blank, whichever makes more sense to you. So this was a nice simple example to get us started. We did a purchase, we did a sale. I suggest you print this off again, make sure you do it without looking at it so you understand this, so when we move into the non-monetary transactions it'll make more sense. It'll be a little bit easier to understand. Okay, so that was page 10. Now we're going to go back and do the chapter. So I'll start that in the next video.